Do you want a financially secure future, not just for yourself, but for your loved ones as well? This is Generations of Wealth, the podcast that breaks down the most effective wealth building strategies you can easily apply to your own life. Join investor and international best-selling author Derek Dombeck in exploring practical tips and sound advice on building a profitable business, creating a powerful brand, or getting into the thriving world of real estate investing. This is your chance to create your very own financial roadmap to live your vision, love your life. Let's begin this discussion with your host, Derek Dombeck.
Welcome to the Generations of Wealth Show. I'm your host, Derek Dombeck, and today we're talking about infinite banking with our guest, Brent Kesler. He is very well renowned. He speaks on many stages across the country about the topic of how to multiply your money, and he calls it Money Multiplier Method. Say that 10 times fast. Before I bring Brent on, though, I do want to mention a couple things just on our level for the Generations of Wealth. We've got the Generations of Wealth Voyage that is going out February of 2025. If you have not signed up for that, if you've not looked into it at all, please go to gowvoyage.com, and you're going to see that we've got about 9 awesome speakers. And this event is once a year, and it's really a must-go-to event, in my humble opinion, as the host. But check that out. Also, we really appreciate anybody that's trying to help us grow our community. Get onto the Generations of Wealth Facebook group, interact with the family, give us the likes and the shares and everything out there on anywhere you're listening to this show or watching this show. And with that, thanks for being here, and let's bring on our guest. And without further ado, Mr. Brent Kesler, thank you for joining us on the show this morning.
Hey, Derek, glad to be here, man. I'm excited to share with your community today.
Fantastic. You know, we were chatting a little bit before we started the show, and I know how awesome, what you're going to share with us is, but can we just start out with you? Tell us a little bit about yourself and where you come from and your backstory.
Yeah, absolutely. So anyway, I'm actually a chiropractor. I no longer practice chiropractic anymore. I have not practiced chiropractic since 2008 myself. I sold my last clinic in 2017. I had 5 clinics in the Kansas City area, and I had docs that worked in the clinics from 2008 on. I now live in Florida. I live in a town called Port Orange, Florida, which is right next to Daytona Beach, about an hour east of Orlando. My wife and I became empty nesters back in 2017, so that's when we moved down here to Florida. I sold all the clinics. And the concept that I teach, the Money Multiplier Method, becoming your own banker, I've been teaching it now around the country, like 50 to 70 live events a year, 100 to 120 Zoom virtual podcast events since March of 2012. So about 12 and a half years I've been teaching the concept. But I was at a chiropractic conference back in 2006 when I first learned about this concept. And I heard somebody on stage speaking about it, and I said, man, that looks really, really good, but it just seems too good to be true, and I'm sure you've seen things like that in the past where it looks good, but it seems too good to be true. Well, that was me back in 06. So I heard this message, and I left and did nothing. I went back to practical life. I go back to another chiropractic conference about 2 years later in 2008. And about 10 or 12 of my chiropractic colleagues that were with me at that previous conference, they did is so they acted upon the information as soon as they heard about it. So they were going on and on about how this banking concept was working in their life, how they were paying off debt, recapturing money, recycling all of their dollars, totally keeping control of their money and their family. And they were basically throwing up all over me about how good this was working for them. So I thought to myself, there has to be something to this, right? There's no way 10 or 12 of my colleagues are lying to me. Maybe 1 or 2, but not 10 or 12. So I came home. It was February of 2008, and I told my wife, I said, honey, We have to start implementing this concept in our life. And so that's what we did. And it was and again, it was at that time, Derek, I was $984,711 in debt. That's what I owed to third-party creditors. Now I know what you're thinking. You're thinking, well, Brent, how do you know exactly how much you were in debt? Well, that was part of the exercise. I had to know what my debt load was, right? So, and of course, I know you're thinking, well, how do you get to be $1 million in debt? I mean, if you live in Kansas, I mean, that buys a lot. I know if you live in California, it buys a very small house, but in Kansas, it buys a lot, right? Well, I had my student loans from chiropractic school. I had my office clinic. I had 2 clinics at the time. And then I had, of course, the house I lived in. I had a house in the Lake of the Ozarks between St. Louis and Kansas City. And obviously, Derek, if you have a house on the lake, you have to have a boat and a wave runner, right? I mean, you can't have a house on the lake without a boat and a wave runner. And then I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take me a lot to become almost $1 million in debt. Well, I was able to apply this concept and this process that I learned, and I was able to pay that off in 39 months, 3 years and 3 months, all by adding one simple step in my financial life. I didn't have to change anything I was doing. In other words, I didn't have to change my cash flow. I didn't have to work any harder, take any additional risk, or lose control of my money. I just added one financial step in my life, and now I've been teaching this concept since 2012.
Well, and if we think back to 2008, it was also during the recession, and where many people were freaking out. And at that point, when you discovered this, I have to imagine that made you feel pretty good getting out of debt before the recession was even really over.
Yeah, exactly. It went from February 2008 to just about 3 years, almost 3.5 years later. So, and it's crazy that you mentioned that, because I bought a house and I closed on that house. It was in March of 2007. And the amount I paid for that house was crazy in 2007, crazy high. And within a year and a half, that thing had plummeted to way less than what I bought it for.
Oh yeah, all my listeners know my backstory, but I lost my shirt and my pants and my socks and everything else in 07 through 09.
Yeah.
So very familiar. So let's just get into it. What, first of all, how come this isn't talked about more often, and what is it?
Yeah. So anyway, the infinite banking concept, becoming your own banker. Anyway, so like it's all driven by a guy that wrote this book. He wrote a book called Becoming Your Own Banker. Okay. And his name was R. Nelson Nash. Now, Nelson Nash was my mentor. And actually, he passed away 5.5 years ago, March of 2019, at age 87 years old. This book, Derek, completely changed my financial life. I mean, I recommend that all of your listeners go out and find that book, Becoming Your Own Banker, and add that to your wealth building library, right? So basically, Nelson teaches the concept in that book, and I've just taken what he's taught and I break it down into much simpler and easier to understand terms. I mean, again, so Nelson was my mentor, so everything, that I teach is driven by him. But the concept is basically driven around a concept to where you could build, keep, and create wealth through your own debts and expenses that you already have. In other words, you can recycle and recapture all of the dollars that are going out. Like I have a 90+ minute video on my website where that's a total recorded video that I go through and I explain the details of how it works with all the handouts and all of that. But just to give you a high level view for this podcast today. So for example, what I do is I show you how to recapture and recycle and get all the money back for every car that you're going to buy, okay? And you're thinking, well, Brent, tell me, what does that even mean, get the money back for a car? Well, look, I don't even know your listeners, but I know how they buy cars. They buy cars one of 3 ways. You either pay cash for a car, you bank finance a car, or you lease the car, right? Because I know they didn't steal the car, right? So what they had to do is they had to take their money, they had to take their dollars and exchange it for the car. Because if we think about the definition of money, all money is a means of exchange. All we do is exchange that money for products and services, for food, for cars, for houses, etc. So what we would normally do is take our money, give it to the car dealer. The car dealer gives us the car. He's got the money. We got the car. Transaction is over. Everybody goes home happy. But if you apply this one simple step in your life, the infinite banking concept, you can now recapture and recycle and get all of the money back for that car that you just bought. So not only do you buy the car, yes, you still give the money to the car dealer. He gives you the car. So he's got the money, you get the car. But now there's a process, there's a system, there's a concept to recapture and recycle and get all of that money back. So that money never leaves your family. You have the car and you have the money. And Derek, if it can be done with a car, it can be done with any product or service that you're purchasing or exchanging money for. It could be done for a bicycle, a boat, a motorcycle, a vacation, a hotel room, your taxes, your charitable giving. Yes, even real estate, even houses, even investing, even lending. I do a lot of real estate investing. I own long-term rentals, short-term rentals, Airbnbs, VRBOs. I do a lot of dollars. So I do a lot of lending. So I'm recycling and recapturing all of that money. Now, I know it sounds crazy. But this concept is not new. It's not on trial. It's not being tested. It's been around for over 250 years. As a matter of fact, if you go and research people like the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, if you go and research them and see how they built, kept, and created wealth, this is the concept they use. Even if you go research Walt Disney, or if you go research and see how Walt Disney World got started, how Ray Kroc funded McDonald's, how Pampered Chef was started before Warren Buffett purchased Pampered Chef. This is the concept that has been used, that the wealthy have been using for over 200 years. I'll give you one more thing out there. There's a guy named Robert Kiyosaki. People in the real estate world know Robert Kiyosaki. He's famous for a book called Rich Dad, Poor Dad. He also wrote another book called Second Chance. Well, in Robert Kiyosaki's book, Second Chance, he talks about exactly what I teach. Also, Tony Robbins wrote a book called Money Master the Game. In chapter 5.4 of that Tony Robbins book, this is exactly what I teach, is what Tony Robbins talks about in that book. But the problem with those two books, the Kiyosaki book and the Tony Robbins book, is when they explain this concept in that book, they make it way, way difficult to understand, and you can't read through what they're really saying. So I've just taken that and I've broken it down into very simple fourth grade, mentality, like verbiage, in order to understand how to apply it and implement it in your life. Now, are you ready for me to tell you what it is and what the vehicle is that we're going to use to build, keep, and create wealth?
Well, it's either that or we just stop the show now and leave everybody in suspense. And by the way, I have some listeners that will appreciate the fourth grade level, So,
listen, man, me one. Hey, okay, here, I got to tell you this. I'm a chiropractor, okay? I no longer practice chiropractic, but it took me 13 trimesters to get through 10 trimesters of Logan Chiropractic College in St. Louis, Missouri, because I kept failing classes. After I finally got my diploma and walked across the stage, it took me 2 extra years to get my chiropractic license, because just because you pass chiropractic school doesn't mean you can practice, because you have to take this thing called the national board exams. And there's different parts. There's part 1 through 4, and there's also a physiotherapy part. Well, part 3, I failed 3 times. As a matter of fact, my mom sent me this little plaque, and it had it right, and it was a small little plaque, and it had a chipmunk, and it was gnawing at some wood, and it said on the plaque, a third time is a charm. No, Mom, third time was not a charm. I failed at the third time. It took me 4 times to pass part 3 of national boards. And Derek, The bad thing about it is that they only give the test every 6 months. So that's why I had to wait so long. So I am not the brightest candle on the cake, the sharpest tool in the shed. Some people even say I'm a couple donuts short of a dozen. So I need things taught to me at that low 4th grade level to understand and comprehend.
Well, that's awesome. And yeah, I obviously want to go into the details, but before that, I think that is so important when, and you said it, the other books are just they're intimidating would be the word I would use, right? And then the concept seems like it's unachievable. So please give us more.
Yeah. So anyway, and then also so as we're on the subject of books, anyway, I wrote a book called Mapping Out the Millionaire Mystery, and a client, which is now a colleague of mine, Chris Naugle. A lot of you guys in the real estate world probably have heard of Chris Naugle, Naugle. If not, go to chrisnaugle.com, watch his stuff. He's got great content out there. But anyway, Chris is very active in the real estate world. He's had a couple shows, real estate shows. He had one on House Hunters, another one on HGTV called Risky Builders. But I will offer this book, Derek, to all of your listeners, and I'll let you explain how they can access that book all through your website and all of that. But yeah, I mean, I'll give them the free ebook version of it. So, but anyway, okay, just to get into the meat and potatoes of what is the product, the vehicle, the machine that we're using to build, keep, and create wealth. And I'm about to tell you what it is, and it's going to surprise a lot of you. And a lot of you, when I say it, you're going to be sitting there with your arms crossed and say, what? How on earth do we ever build wealth doing that? Well, but anyway, just hear me out. So the product that we're going to use to build, keep, and create wealth is a whole life insurance policy in a mutual company that pays dividends, that is specifically designed and specially engineered for high immediate cash value. Now, here's what I just said there. I mentioned the word life insurance, and I can almost see everybody out there listening. They just turned off, shut down, exit out, go to something else. I'm going to go walk the dog, watch TV, burp the baby, wash the dishes, whatever. The guy just said that negative word, life insurance. And that's how I'm going to build wealth. And here's what the audience is thinking. Well, Brent, there's no way you can build wealth with life insurance. I know everything there is to know about life insurance, and you would never want to use that vehicle to build, keep, and create wealth because Dave Ramsey and Susie Orman said it was a bad idea. Well, let me just tell you, you do not know everything there is to know about this concept, because if you did, you would be applying this in your life. Now, I want to be clear. This is not any type of life insurance policy. In other words, it is not a term policy. It's not a variable policy. It's not a universal policy. It's not an IUL index universal life policy. No, no, no. This is a specifically designed, specially engineered whole life insurance policy that is in a mutual company that pays dividends, that is designed for high immediate cash value. Now, when I say high immediate cash value, I mean when you put that money into the policy, you immediately, and my definition of immediately is within 30 days, you immediately have high cash value that you can use. And it has guaranteed growth, which means it can never, ever, ever go down in value. It can only increase. That's not me telling you that it can only increase. That is in your policy contract. As a matter of fact, nobody in your state of Wisconsin, Derek, or my state of Florida, or any state in this country, nobody has ever lost money in a whole life policy in a mutual company that pays dividends. Go look it up and try to find it. You won't find it. So it is not the type of policy that you can go buy from your brother-in-law that sells life insurance, right? We all have a brother-in-law that sells life insurance. It is not that type of policy. It's that specifically designed, specially engineered policy. Now, why do we use this? Why do we want to use life insurance to build wealth? Well, there's a lot of reasons, but the main reason is because this is what the wealthy do. This is what the rich do. As a matter of fact, Derek, the number one purchasers of whole life insurance in the world are conventional banks. Conventional banks own more in whole life insurance than all of their land and their buildings combined. As a matter of fact, since 2014, conventional banks have quadrupled the amount of life insurance they have purchased. Now, why do you think banks are buying so much in whole life insurance? Is it because they're stupid, or they know something the rest of us don't know? They know something the rest of us don't know. So all we're going to do is mimic and imitate what the rich and the wealthy have been doing for over 200 years. I'm not going to reinvent the wheel. All right. I'm just going to do what they've been doing. Anyway, so there's a quote out there, and I don't know just when this quote was said, but it was a quote by this guy named Warren Buffett. And Warren Buffett said this quote. I heard it for the first time in October of 2008. Now, I don't know when he said it, but October of 2008 is when I first heard it. And I think about this quote every day of my life, and this is how simple I like to keep things. And here's what Warren Buffett said. He says, if poor people would just do what rich people do, they wouldn't be poor anymore. How simple is that? And that's exactly what we're doing. I'm not going to go out and create something brand new. Like, okay, again, this banking concept, I didn't create it. The guy that wrote this book, R. Nelson Nash, didn't create it, right? All we're going to do is apply these principles and concepts that the rich and the wealthy have been using for 200 plus years. And I'm applying them in my life, and I'm building wealth and getting wealthy right along with them.
Absolutely. And I've known about this concept for a while, which is why I was excited to bring you on the show. And I've been using it for a number of years now as well. And I don't know if you want to expand much on why the banks are doing that, but one specific thing that I used it for was I used to co-own a hard money lending company, and we had key employees within the company. So we were the company, my company would buy the life insurance policy on our employees, which is a form of key man life insurance. But we did it specifically with this type of policy, as you're talking about, and that cash value can be used as deferred comp to the employee, or you don't have to give it to them. I don't know if you want to touch on any of that at all, but
yeah, absolutely. A couple things, right? You kind of touch on a few things there. And anyway, I'll just give you one example. Like, there was an article, and I remember the day because I have this article when I do my presentation. I have it pulled up. It was November 16th of 2016. And I was about to go live on stage and speak about this concept on that day in Denver, Colorado. I got there a little early. I opened up my computer, and, you know, if you're a sports fan like I am, it's a great time to go on ESPN.com and look at sports scores. November 16, 2016. And here this article comes up, and it says Jim Harbaugh, at the time the University of Michigan head football coach, the University of Michigan is just now making Harbaugh the top paid coach out of all the major college universities. And the way they're paying him is through a life insurance policy. So what they're doing is they're paying his salary through a life insurance policy, which means it's a great benefit for Jim. And it's also a great benefit for the University of Michigan, because when you run your money, when you run your payroll, because I used to do this in my chiropractic clinic too, I would pay my staff, as far as my workers, I'd buy my equipment, my headrest paper, my x-ray film, my therapy modalities. I'd run all that money through the policy, just like I explained earlier on the car, so you could recycle and recapture and get all the money back. Well, that's what the University of Michigan was doing there for Jim Harbaugh, right? So they're recycling and getting all of the money back, plus paying his salary, okay? So on banks, and the reason that banks use it, well, banks have, and exactly what you said, because the question I get asked all the time, well, who are banks insuring? Well, they're insuring their top brass in their banks. Like, have you ever noticed, even today, when you go into any conventional bank, they have all these vice presidents in one branch. You have the vice president of loans, the vice president of tellers, the vice president of the safe deposit boxes, right? All these key people that they have that the banks are able to put policies on, right? As a matter of fact, even before I knew anything about this concept, when I was in chiropractic school, my wife worked for a company in Chesterfield, Missouri, right outside of St. Louis. It was called RGA. It was, RGA stands for Reinsurance Group of America, which is a sister company of MetLife. Remember Snoopy, Metropolitan Life? Well, anyway, my wife worked for this company. Well, when she got hired, part of her hiring package was they were buying a life insurance policy on her. Now, not to her benefit, and she had no idea why. She was just going through all the paperwork and the hiring process. But now later I understand, because when you hire these key employees, you can actually insure them because you have a vested interest in them and own a life insurance policy on their body. Today, Derek, I own life insurance policies on people that I don't even have in my life anymore, such as chiropractic associate doctors, because I no longer own chiropractic clinics. I sold all my clinics. I sold most of them to the docs that were in the clinic, but I don't have any interest in them anymore, but I still own the life insurance policy. And that's what banks are doing. That's what even, like, as far as RGA, that's what they did. Even Walmart, up until about 8 or 10 years ago, I might be off a little bit on the time, but the thing that if you want to go out and do the research, Walmart was buying life insurance on all of their employees. Without them even knowing about it. They can still do it to this day. The only difference is that the employee has to know what's going on. But I mean, go do that research. So the reason they're doing it is because there's no better place on the planet for you to store your wealth other than inside of a whole life policy in a mutual company that pays dividends that's designed for high cash value because of the features and benefits that come along with it. And I've been looking since 2006, so 17 years now. I've been looking for a better machine, a better vehicle, a better place to build, store, and keep wealth, and nobody's been able to show it to me. So maybe if your listeners have somewhere better, maybe they'll share it with me and I'll stop teaching what I'm teaching and teach whatever they show me, but I have not found it up to date. Now, let me expand a little bit more to kind of peel back the onion. Whenever you put money into a life insurance policy, remember, it's going into a mutual company that pays dividends. Very important that it's a mutual company. Well, okay, people are saying, well, I don't understand, Brent. What does mutual mean? Mutual means is that there are no shareholders, there are no stockholders. It is mutually owned. You own the contract, not the insurance company you don't own. You own the contract. And what that means, there's no stockholders or shareholders. Like if you put money in a conventional bank, and let's say you put it in a CD, a certificate of deposit, well, who's making all the money on a CD? It's not you. I mean, they're giving you a little bit of interest, right? And again, they're hoarding your money. They're keeping it for X amount of time, 12 months, 24 months, 60 months, because you can't go get the money out the CD without paying a penalty before that time frame is open, before that time frame is up. So they're making all the big money on that, and they're controlling it, the stockholders and the shareholders. Well, in the insurance company, it's not like that. You are the policy owner. You own the contract. And what that means, Derek, is that you have first right to your money. You see, anytime that we pay premium into an insurance company, the insurance company takes that money and they put it to work. And I'll just tell you, a whole life company that's mutually owned, they take about 80% of the people that pay premium. They take about 80% of those dollars and they put it into investment grade bonds, very safe bonds. And they take about another 7% and put it into commercial lending. A lot of shopping plazas, a lot of shopping centers, a lot of real estate developments are financed by blocks of money through insurance companies. Another 7%, they are going to use for policy loans to their policy holders, which is what we do. We're taking policy loans, and the other 7% has to sit in a very low interest bearing account, almost equivalent to cash, because when death occurs, that death benefit has to be paid out in a timely fashion. Now, let's say the insurance company has all that money earmarked out into those areas, but you come knocking on the door and you say, Mr. Insurance Company, I want access to my cash value in the policy. You are number one in line. It doesn't matter what the insurance company has to do, even if they have to go out, pay penalties, get it out of investments or whatever, they have to get that money and they have to give it to you. You're number one in line. So now here's the cool thing about this. Whenever you borrow money from the insurance company, okay, like when you have your policy and you have a cash value and you're thinking, okay, well, I'm just going to take some of my money out of the policy. Well, no. You're not taking your money out of the policy, because if you took your money out of the policy, that would be considered a withdrawal. You don't want to do a withdrawal for lots of different reasons, and we can get more into that. But what you want to do is take it out as a policy loan. And when you take it out as a policy loan, here's what you're doing. You are not taking your money out of your policy. You're simply putting your policy up for collateral. You're taking a loan from the general fund of the insurance company, which is a great thing because all your money that's in the policy is continuing to grow and compound in that internal tax-free growth rate environment, and the government's completely out of your hair. So the insurance company never asks you, why do you want to take a policy loan? And they never ask you if and when you're going to pay the policy loan back, because they don't care. And the reason they don't care is because when you take a loan against your policy, so keep in mind, in the insurance policy, the death benefit will always be higher than the loan availability or the cash value. And the thing that you and I both know, Derek, and everybody else on this call knows, is that it's not an if we pass, die, or graduate. I like to use the word graduate instead of die, but you use whatever word you want. It's not an if, it's a when. So when we pass, die, or graduate, what would happen is that death benefit is going to pay off any outstanding policy loan if you hadn't paid it back. And then the additional money goes to your beneficiary tax-free. So let me give you an example. Let's say your death benefit on your policy is, say, $1 million. And let's say you have $600,000 of cash value, and you've taken out that $600,000 to fund your real estate deals or to pay your debts, expenses, buy cars, go on vacations, whatever you do with that money. You've taken out $600,000 of cash, but the death benefit is $1 million. And all of a sudden today is your graduation, Derek, and you pass. So what happens is the $1 million death benefit pays off the $600,000 policy loan, because they've already given you that $600,000 while you're living. And now what happens is they pay off the policy loan. So now your beneficiaries will get all the assets that $600,000 loan paid off. And hopefully you bought some assets with it and didn't go last week to Las Vegas and say, let's try my luck. Hopefully you bought some assets. But not only do you get all those assets, but plus your beneficiaries will get the additional $400,000 in death benefit that goes to them tax-free. So essentially what we're doing, Derek, is we are using a portion of our death benefit while we're living. We're using that while we're living instead of what most people think about when they think about life insurance is like, oh, well, I'm not going to benefit for this, but my kids, my grandkids will. No. We're using a portion of it while we're living instead of having to leave the whole entire death benefit to your ungrateful children. Or Absolutely. Am I the only one on the call that has ungrateful children?
I'm pretty sure you're probably not. And we're not going to really dive into it because we don't have the time. I mean, we could go over this for hours, and I know you're a wealth of knowledge, but I do want to just mention, depending on how you structure this, the tax benefits alone, depending on who's paying the premiums, if it's a personal policy, if it's paid for by a company, all these different things. And Brent and I are not giving anybody legal or tax advice. So this is just from my own experience, and Brent's obviously got a lot more experience than I do, but it's a really, really cool tool for sure.
Yeah. So, yeah, just on the tax thing, you're exactly right. I'm not a tax expert, but here's the thing I know: the policy can never put you in a worse position tax wise. Never. It can only improve your tax position. But with that being said, I encourage people not to start a policy like this simply for the tax advantage. That would be the wrong reason to start it. And if that's the only reason you're doing it, I would suggest not doing it. The reason you want to do this is so you're able to recapture, recycle that money that has been leaving your family. Because anyway, Derek, let's just think about it. Every product or service that we buy, we have to take the money and give it to someone else. And in exchange, they give us the product or service. Well, that money is gone. It's left our family forever. It's gone. So now if we can just keep that money, if we can keep the money in our family and keep total control of it and be able to do everything that we want to do in our financial life, it puts us in a way better position. The last big bullet point I want to make is in that 90+ minute presentation that you're going to share with your listeners of how to listen to, I go into specific details of how you can borrow at a higher rate than what you earn and make money all day long. For example, if I earn 4% and I pay 6%, you would think that I'm losing 2%, okay? But no, it's not that way at all. I'm actually making more money earning 4 at the same time I'm paying 6. Another example would be is if I earn 10% and pay 20%, well, you would think you were losing 10, right? If you earn 10 and pay 20, you would think in your mind you're losing 10, but that's not the way it works. And I go over in great detail the mathematical equation and the process on a financial calculator of how that works. And that's huge, because here's what we want to do, Derek. The thing that we want to do is we want to pay tax. We want to pay as small amount as tax as possible, one time only. And what we want to do is get our money into a tax-free environment where it's building and growing tax-free and the government is completely out of our hair.
Absolutely.
If there's any listeners out there that want government control and they love government control, you're not going to like what I teach.
Yeah, and I'm pretty sure, I'm going to go out on a limb here. I'm pretty sure I don't have many of those listeners following the Generations of Wealth. Yeah. But, well, listen, everybody can go to thegenerationsofwealth.com/multiplier, and that will link you up with Brent's website, the free ebook. You'll be able to find the 90-minute presentation. And again, that's thegenerationsofwealth.com/multiplier. And Brent, time went by really, really fast. You and I could probably talk about this for a lot longer. However,
well, dude, I think we should do a part 2, part 3 sometime. You know, let's just not make this the end. This is the beginning of a relationship.
Absolutely. Well, I appreciate part 1 more than you know. And thank you so much for taking some time out of your day.
Well, thank you. I appreciate you allowing me to be on and being able to serve your community. I appreciate that very much.
Well, I will let you get going. But to everyone else, thanks for following the show. If you just found us, thanks for being here. Please go out there and do everything you can to support the Generations of Wealth show, whether it's sharing it, liking it, giving us, rave reviews, follow Brent and all of his endeavors. Once you go to thegenerationsofwealth.com/multiplier and get connected with Brent. And until the next show, go out, live your vision, love your life.
Thank you for joining us on another insightful episode of Generations of Wealth. May your newfound knowledge help you in leveling up your own strategies to get through the many obstacles to your money-making processes and bring you much closer to the financially secure life you truly deserve. Continue filling up your accounts and further polish your financial tactics by listening to more episodes of the podcast at thegenerationsofwealth.com. Because in your wealth-building journey, there is no other way to go but up, giving you the chance to finally live your vision, love your life. That's all for now. See you on the next one.